Good morning. Here's your quick read on the tone of the market heading into the open. No predictions, no noise, just the overnight moves, the early signals, and the outlook for the day ahead. Let's get into it. Iran signals willingness to negotiate. Oil retreats to $109. S&P 500 futures plus 0.89%, Nasdaq plus 0.84%, Dow plus 0.92%. Non-farm payrolls at 8:30 a.m. Eastern Time, and here's the pre-market read. And U.S. index futures are solidly higher this morning as the market welcomes de-escalation signals from Iran. The S&P 500 futures are at 6,410, up 0.89%. The Nasdaq futures are at 23,320, up 0.84%. The Dow futures are at 45,550, up 0.92%. This is a significant shift from Monday's fragile bounce. The market is now pricing in a scenario where negotiations progress and the war doesn't expand further. Oil prices have retreated sharply. Brent crude is down 3.1% to $109. WTI is down 3.0% to $99.50. The geopolitical risk premium is fading as traders believe the worst-case scenario, Houthis disrupting shipping, oil spiking to $120 plus, may be avoided.
The story: Iran signals willingness to negotiate. Overnight, Iran signaled a willingness to return to the negotiating table. Iranian officials said they are open to discussions on a ceasefire, marking a shift from their previous, maximalist and unreasonable dismissal of the U.S. ceasefire plan. This is a significant development. It suggests that the Houthi escalation didn't trigger a broader war. Iran didn't respond with massive retaliation. Instead, they're signaling a desire to negotiate. Trump's "finish it" comments may have worked. The threat of escalation may have pushed Iran back to the negotiating table. Oil prices are normalizing, with de-escalation hopes rising. Traders are unwinding the geopolitical risk premium that pushed oil to $112.50 yesterday. The market is interpreting this as a positive signal. If negotiations progress, oil could retreat further, potentially to $100 to $105. That would be structurally deflationary and could allow the Fed to consider rate cuts later in the year. The pre-market tone. Futures are up solidly, and the tone is optimistic. This is a relief rally after Monday's fragile bounce. Traders are now pricing in a scenario where negotiations progress, oil retreats to $100 to $105. The war doesn't expand, the Fed can eventually cut rates, and equities can rally from correction territory. But there are caveats. This is month-end positioning. April 1st marks the start of Q2. Traders may be buying ahead of the quarter change to improve month-end performance. This could reverse quickly if sentiment shifts. Non-farm payrolls at 8:30 a.m. Eastern Time, the most important economic data of the week. If the jobs report is weak, it could trigger selling. If it's strong, it could support the rally. Oil is still elevated. At $109, oil is still above pre-war levels. If negotiations stall, oil could spike back above $112. The April 6th deadline looms. Trump's pause on Iranian energy strikes expires April 6th. If negotiations don't produce results by then, the market will reprice lower. What's on the calendar? 8:30 a.m. Eastern Time, non-farm payrolls, March. The headline number. Consensus is expecting 200,000 jobs added. If the number is significantly weaker, 150,000 or below, expect selling. If it's stronger, 250,000 plus, expect the rally to accelerate. 8:30 a.m. Eastern Time, unemployment rate, expected to hold at 3.8%. A rise to 4.0% plus would signal labor market weakness. 8:30 a.m. Eastern Time, average hourly earnings. Watch for wage growth. If wages are accelerating, the Fed will stay on hold longer. If wages are decelerating, the Fed could cut rates sooner. Throughout the day, earnings continue. Watch for any guidance cuts or warnings about geopolitical impact. The setup. The market is caught between two forces: bullish, de-escalation signals from Iran, oil retreating, month-end positioning. Relief rally after 5 straight losing weeks. Oversold technical setup. If NFP is weak, the Fed could cut rates sooner. Bearish, non-farm payrolls could disappoint. Oil is still elevated. The April 6 deadline is approaching. Negotiations could stall. The market is still in correction territory. Consumer sentiment is weak. The key variable is the non-farm payrolls report. If it's weak, below 150K, expect a sharp rally as traders price in rate cuts. If it's strong, above 250K, expect the rally to fade as traders realize the Fed will stay on hold longer. For now, the market is celebrating de-escalation, but the celebration is conditional on the jobs report being weak enough to justify rate cuts later this year. The bottom line. Tuesday morning brings a significant shift in sentiment. Iran's de-escalation signals, oil retreating, and month-end positioning are all supporting a relief rally. But the rally is fragile and dependent on the non-farm payrolls report. If NFP is weak, expect a sharp rally and a potential break above 6,400 on the S&P 500. If NFP is strong, expect the rally to fade and a potential retest of Monday's lows. Watch the jobs report. This is the most important data point of the week. Thank you, and good day.